Thank you, Jamie, and thank you to the Deerfield Library for thinking that this kind of education is important enough to be delivering. This is a topic that I've taught off and on over the years, and as a result of some of the somewhat major changes that were made by the Secure Act just before the pandemic, I think a lot of folks now are wondering, do I know what the rules really are and so forth. And since the pandemic did come so close after the passing of the Secure Act, it didn't get a lot of attention. And so you probably kind of saw a headline, but never really saw a lot of details. So I'm glad you're joining us tonight to talk about this. And just to elaborate a little bit on my background, Jamie gave me a very nice introduction, but to let you know, financial education is what I do and what I have been doing for over 25 years now. I did get the Certified Financial Planner designation a number of years ago, probably more than 20 at this point. But I don't take clients. I got that designation because of the rigorous training it required so that I would feel comfortable covering more intricate topics like tonight as part of my educational programs. But I am strictly education. I do not sell any financial products or services. And so I want you to be reassured that there's no hidden agenda here. And my goal is that the information that I deliver to you is as accurate and as unbiased and non-commercial as possible. And just a reminder that tonight is education and it's not advice. In other words, I'll be teaching you the rules about how you can take money out of retirement accounts and what penalties or taxes or whatnot apply, but I'm not giving you advice about what the correct strategy would be for you. This falls under the category, I think, of retirement income planning, which has a lot of income tax thinking involved. That can get fairly complex. And so you may, even after hopefully you learn some more about this tonight, you may decide that you need a qualified professional to work with for advice specific to your situation. That's beyond the scope of tonight's program, but I do want to point out that in addition to resources specific to tonight's topic, if you go to KarenChanFinancialEd.com and go to the resources tab, if you click on Finding Financial Advice that's right for you, you'll find a number of tools to help you understand the different types of financial advisors in our U.S. regulatory system, even some suggested interview guides for how to select someone. So some tools there that may be useful. And then under the topic of the title of tonight's program, Taking Distributions, you will find resources that elaborate on some of the particulars that we're discussing this evening. So what are we talking about tonight? We're talking about most employer retirement plans and IRAs. In general, they follow the same rules. So whether you have an IRA, 401k, 403b, 457, what we discussed tonight should be pertinent for all of those. And within each of those types of retirement accounts, you may find two flavors, for lack of a better term. One flavor is the traditional, the tax-deferred version of retirement accounts, where typically when you put money into the account, often out of a paycheck, you do not pay tax on that part of your income that year. You pay the tax down the road when you actually take the money out of the account, and presumably when you would be in a lower tax bracket due to lower income once you are in retirement. The other flavor is the Roth version, which turns that traditional idea kind of around on its head. With a Roth account, there is no tax benefit in the year you put the money in the account. You do not get to avoid paying tax on that part of your income. The benefit that you do get is tax-exempt growth, provided that you follow the rules for distributions 5 or more years down the road. So all of those we're going to be talking about tonight. And there are several ways in which we take money out of retirement plans. We're going to spend just a few minutes on loans and hardship withdrawals because those are the two ways that you may be able to access funds in your retirement accounts during your working years. Then we're going to talk about the more standard things that a lot of us deal with retirement accounts: rollovers and conversions, actual distributions where you take the money out, typically intending to use it to spend, and then beneficiary rules, because although they will be taking distributions, the rules for beneficiaries are different from the rules for the original account owner, and those have changed significantly as a result of the Secure Act in 2019. So let's talk just a moment about loans. Loans are not available from IRAs. They're only available from employer plans, typically 401k, 403b, 457, but not all of those accounts are going to allow loans. It depends on the exact rules that your plan is set up to allow. However, there is a federal limit on the amount that you can take out as a loan. The limit is the lesser of either 50% of your vested balance, vested meaning the money that you're actually entitled to at this point. There may be more money in your account, but if you aren't vested, you wouldn't be able to take all of that money if you left before the vesting years of service requirement is met. So the limit is typically lesser of 50% of the vested balance or $50,000. The exception is if your vested amount is less than $10,000 to start with, then you could borrow the entire amount. You have 5 years to repay, although it can be longer if you took the money out specifically for a home purchase. One of the catches about loans is that if the loan has not been repaid when you leave employment, the general rule is that the unpaid amount will be taxable income. And if you're under age 59 and a half, you could also be paying a 10% penalty on top of the taxes. There is a way to avoid that, that you would roll over an amount equal to whatever your loan balance is, or whatever portion of it you're able to do, to deposit an amount into an IRA and have it treated as a rollover, if you will, of that loan balance or some portion thereof. There were some special rules for loans during the CARE Act last year from March 27th to September 22nd. Obviously, the time period for that has passed. The only thing to remind you about at this point is if you did take a loan under the special CARES Act rules, it means that you have perhaps a higher amount to repay because the loan limits were higher, and that your repayment starting date may have been delayed. So don't lose track of that if that applies to you. Hardship withdrawals are the other way to access funds in a retirement account while you are still underage or still employed by the employer where the account is held. Now, hardship withdrawals are only for employer plans and only for non-IRA employer plans. There are some employer plans that have IRA in their name, like SEP IRAs, like simple IRAs, and those do not allow hardship withdrawals. But if you have a 403B, 457, 401k, if the plan rules say it allows hardship withdrawals, then this is something that could be an option for you. The stipulation is that you must have what is defined as an immediate and heavy financial need. There used to be a bunch of other restrictions. Most of those were relaxed a couple of years ago. But remember that a hardship withdrawal is taxable. It cannot be rolled over. Even if you eventually come up with the money, you can't just replace the money in the account. It is a withdrawal. Now, having told you that, I have to say that during the coronavirus in 2020, there was a special type of hardship withdrawal available known as coronavirus-related distributions. So if you took a distribution last year, it's possible that you qualified as this, but you or your spouse or either had to have had COVID or some other adverse financial consequence as a result of the pandemic. If so, you were able to avoid the 10% early distribution period. It was still taxable income, but That taxable income could be spread over 3 years, meaning that you have to remember to report it on 3 years of income tax returns. And this was the biggest special rule for coronavirus related distributions. You were allowed to repay it as if it had been a rollover with an extended rollover time period. And so remember, you have 3 years. If you took one of these special distributions, you have 3 years in which to repay the amount that you took out and therefore avoid tax, which could mean filing amended tax returns, since you will have already had to declare some of the income on tax returns. All right. Now, moving on to things that more of us are more likely to deal with at some point with our own individual retirement plans. So I mentioned rollovers and conversions in the headline part at the beginning of tonight's program. But I'm gonna stick transfers in here as well, because technically not all movement of money from one account to another is a rollover. It may be a transfer, and of course conversions are a very special type of those. So what is a rollover or transfer? It means moving money from one retirement account to another without changing the tax status. So if you started with a tax deferred account, you're moving it to a tax deferred account. If you started from a Roth account, you have to be moving it to a Roth account. That's why these are called rollovers or transfers. Now, if you're currently working and you have a retirement plan with your current employer, employer plans may or may not allow you as a current employee to do rollovers. If they do, it will be referred to as an in-service rollover. Some employer plans allow it, some do not. But the one thing to always ask yourself when you're doing a rollover or a transfer to a different account is, am I subject to required minimum distributions this year? If you are, you have to take those required minimum distributions first, and then with additional money, you can do a rollover from one account to another. But you cannot roll over the amount that you're required to take that year as a distribution. And if you do try to do a rollover without having taken your RMD first, you're going to cause yourself a lot of heartache and perhaps a lot of tax dollars as well. The worst case scenario would be that your rollover is disallowed and the whole amount is treated as taxable income because you failed to take that RMD first. So types of rollovers. We have first what we refer to as a direct rollover. It means going directly from one plan to another. It can be going from one retirement plan to a similar employer plan or to an IRA. Trustee to trustee transfer is the same general concept, but it originates from an IRA rather than from a retirement plan. I used to think that this wasn't anything to even worry about, but there's a rule I'm going to introduce you to shortly that points out why this is actually important. So rollovers, direct rollovers come from an employer retirement plan. Trustee to trustee transfers originate from an IRA. But either of them can go into an employer plan or an IRA. That doesn't matter. The third type of rollover is the one that you generally want to avoid. You'll hear it called a 60-day rollover or an indirect rollover. In this case, instead of having the money transferred directly to the new custodian, you're taking the money out directly yourself, typically either in a check made payable to you or maybe a deposit to an account that you have control over, not a retirement account. If you do this, you have to redeposit the money to an IRA or a retirement plan within 60 days. That's why it's called a 60-day rollover. But there are some complications. First of all, as we already said, you have 60 days to complete. And if you miss the 60-day deadline, you're generally going to be facing taxes on the entire amount. One of the reasons you might have difficulty rolling over the entire amount is the factor that's here on the green bubble about with tax withholding. If an employer plan sends you a check or gives or deposits money into your personal account, not a retirement account, they are required to withhold 20% for taxes because they don't really know for sure that you're going to do a rollover. And so the federal government says 20% mandatory withholding. You'll get it back if you roll it over, but not until next year when you file your taxes. And if you're taking a rollover, taking a 60-day distribution from an IRA, by default, they will withhold 10% for taxes. You can request it to be different. You can request it to be zero. But let's say with that employer plan, since that's where the biggest issue is, let's say you had $10,000 in your plan. You tell them that you want to take the money out, and they say, well, how would you like that? And you say, oh, a check. So you get a check in the mail, but instead of 10,000, the check is only for 8,000 because 2,000 was withheld. Well, now you go to deposit the money into your new account, you only have $8,000. If that's all you deposit, you're going to have a $2,000 taxable distribution. You're going to have to go find $2,000 of other money somewhere that you can put with that 8,000 so that you are rolling over the entire original account balance of $10,000. If you can do all of this, okay, then 60-day rollovers probably aren't a bad idea for you. But as you can see, there are risks and complications. And so the general recommendation is avoid them and stick with the custodian to custodian, the direct rollover or the trustee to trustee transfer, depending on which type of account you're coming from. But just a word about that 60-day limit. There are some exceptions to that. One that's automatic is if you can show that you sent the money in time to the financial institution that was supposed to deposit it in your new account, but they failed to deposit it in a timely manner. That's an automatic exception to the waiver. Some very wealthy people who were dealing with large amounts of money actually would seek private letter rulings from the IRS saying that they got a waiver of the 60-day limit, but that costs $10,000. Most of us don't go there. But what the IRS has done relatively recently is they've come up with a list of several possible reasons why you might have legitimately missed the 60-day deadline, and you get to self-certify that one of these applies to you. It could be postal error, which I'm guessing back in November and December, a lot of individuals who were trying to do 60-day rollovers kind of got messed up because our post office had difficulty coping with the volume of mail at that time. If you were seriously ill, if you simply mislaid the check, maybe you just plain couldn't find it before the end of the 60 days, but you didn't do anything with the money. It simply was waiting to be deposited. Those are things you can self-certify. They could ask you for verification. It's not a guarantee that you'll avoid the penalty, but it gives you a good shot. Now, here's why I now distinguish between rollovers and transfers, because we have this rule that there is a limit of one rollover from any IRA per 12-month period. Now, this is the wording that the IRS uses, a limit of one rollover from any IRA per 12-month period. Now, I've inserted the word indirect because when we work through here and see what this rule really means, it doesn't apply to every transfer of money from an IRA. It only applies to certain ones. First of all, it doesn't apply to rollovers that are originating from a retirement plan, meaning an employer plan. Okay, if you're moving money from your 401k, 403b, 457, you do not have a limit of how many of those transfers or rollovers you can do. This limit also does not apply to trustee transfers from an IRA to either an IRA or another retirement plan. Also doesn't apply to conversions. If you're taking money from an IRA, converting it into a Roth IRA, that doesn't count here either. The only thing it applies to is that 60-day indirect rollover coming from one IRA and going either to another IRA or some other type of retirement account. That's the only one that we have limits on. but it is a strict limit. If you try to do a second rollover of this type, a second rollover of the 60-day or indirect type, the second one will be disallowed, again, resulting in taxable income of the amount that you were trying to roll over. This doesn't hit a lot of people, but it can catch you by surprise if you are doing something unusual, which often happens when somebody is at the point of retirement, starting to move money around, or approaching the age for required minimum distributions and trying to sort of reallocate things. Now, a word about rollovers and beneficiaries. Beneficiaries can only do direct rollovers. They cannot do the 60-day or indirect rollovers. So they can roll money from one inherited IRA to another, or they can roll money from an employer plan to an inherited IRA. But in all cases, the title has to remain in such a form that it includes the name of the deceased, the original owner, and simply names the beneficiary as beneficiary. So it might say something like, IRA of John Doe deceased for the benefit of Jane Doe daughter. It might say something like that, but it cannot remove the name of the deceased when the rollover takes place. If a beneficiary doesn't know this rule and the financial institutions they're working with are not on their toes, a beneficiary could inadvertently really get themselves in trouble by trying to do a 60-day or indirect rollover. Meaning, if you recall, that it means the beneficiary has requested the money, either via check, maybe a deposit to their own personal accounts. They have had control of the money. That doesn't work for beneficiaries. It works for owners, but beneficiaries cannot do that. If they try to do a 60-day rollover, it will fail. And again, they will end up with an unremediable situation where it'll be a fully taxable distribution. End of story. So let's talk now about conversions. You're changing the nature, the tax nature of the money when you do a Roth conversion. You do it by converting money from a traditional account to a Roth account. The amount that is converted, because you're going from tax deferred to an account where all the money must have already had taxes paid on it. So you're creating taxable income. The amount of money that you convert will be declared as taxable income in that year. So let's say you've got a fairly large tax deferred retirement account. Maybe you've got $100,000 in it. You've been thinking about doing a conversion. Now you're realizing, oh my, $100,000 of taxable income on top of everything else in 1 year. Not sure I can handle that. Well, the good news is that you can do partial conversions over several years to manage that tax bill. What a lot of people will do is, or their advisors will guide them. Let's say that right now you're in the 12% tax bracket. You've got a few $1,000s of additional income you could have before you go all the way up to the 22% tax bracket. You might, for a period of years, take just enough money and do a conversion to fill up the rest of that 12% tax bracket. So we're going from traditional to Roth. You can be going, there are 3 different ways you could do this. You could be going from a traditional IRA to a Roth IRA, or it could be in a retirement plan with your employer where you may be able to do an in-plan conversion. It's still within your employer's plan, but it went from traditional to Roth, still creating taxable income. Or you could have money in an employer plan, but rather than converting it inside the plan, you are moving it to a Roth IRA and therefore doing the conversion. It used to be that this third one was not allowed, that you had to first convert to a traditional IRA, and I'm sorry, you first had to transfer or roll over to a traditional IRA and then do the conversion. That 2-step process is no longer required. You can go directly from traditional retirement plan with your employer to a Roth IRA. No having to go around the mountain to get there. A lot of people are curious about when to consider conversions. And let me say one thing that I guess in my mind has become so apparent that I failed to actually write it down here. In most cases, you should only consider converting from traditional to Roth if you have money other than the money you're converting that you can use to pay the taxes. If you're going to have to take money out of the conversion to pay the income taxes, financially, the numbers probably will not work out in your favor. But times in particular to think about doing a conversion would be when you find yourself in a year where your income is lower than normal, or you've had large deductions. I think about elderly individuals or couples who suddenly find themselves with huge medical costs because of skilled nursing home care. Either of those things, lower income or huge deductions for medical expenses, could put you in a lower tax bracket for that year. And converting from traditional to Roth would be one way to take advantage of being in that lower tax bracket and use the conversion to fill up that lower bracket that you're in right now. Other individuals consider doing conversion because they're approaching age 72 when they're going to be required to take RMDs, required minimum distributions, and they don't want to do that. They don't need the money. They don't want to be forced to take the money out. And so they will be looking to do a conversion, but not just any conversion. Specifically, the money needs to go into a Roth IRA. They should not do an in-plan conversion with their employer plan. They're going to need that money to end up in a Roth IRA because it is the only plan that does not have required minimum distributions for the account owner. Others who have an issue of large assets and are concerned about estate tax, that's a situation where the appeal of doing a Roth conversion is that if they do the conversion and pay the taxes on that now, it will reduce the size of their estate, and the amount of tax that they paid on the conversion is no longer in the estate, and it reduces the amount of estate tax that could be owed. But right now, only individuals with estates of 11.7 million and higher are subject to estate taxes currently. Now, I do want to point out that barring future legislation, that number will revert back to the $5 million number than it was before the Trump tax law, and it'll be back to 5 million plus whatever the inflation amount has been in the interim starting in 2026. All right, so let's talk about now actually taking the money out. Not rollovers, not loans, not hardship withdrawals, but taking standard distributions. The thing that drives the rules for distributions is your age. We have three categories. We have people who are not yet age 59 and a half. We have people who are between 59 and a half and age 72, and then those who are 72 and older. And the rules that apply, as you can see, are different. The general rule is if you are not yet 59 and a half, when you take money out of your account, you will pay not only the income tax that's owed, but an additional 10% early distribution penalty. There are exceptions. This rule does not apply to state and local government 457 plans. And there are some other exceptions to the 10% penalty, and I'll cover those in a minute. But first, let's just point out that for individuals between the ages of 59 and a half and 72, I think you're the golden group, because not only do you not have any penalties for taking money out, you also are under no obligations to take money out. You can leave it untouched. You could take it all out. Your only obligation is to pay tax on any tax deferred money that you do withdraw. But then you hit age 72, used to be 70 and a half, if you'll recall. But now once you reach age 72, you have to take required minimum distributions, which we abbreviate as RMDs, each year. And you have to take it by December 31st of each year. Now, there's this thing called your required beginning date, the deadline for you to take your first RMD. And for the first one, they give you a grace period. You would normally only have until December 31st of the year to take out your first RMD, but for the first one, there's a grace period all the way up until April 1st. So April 1st of the year following the year you celebrate your 72nd birthday is the deadline for your first distribution and is known as your required beginning date. Pay attention though, for those of you that are looking at this, maybe coming up soon for you. The grace period may sound appealing. It may work well for you, but the downside of using that grace period is that your second RMD is going to be due by December 31st of that same year, which will give you two taxable distributions in the same year. That could be more taxable income, putting you into a higher tax bracket than if you had gone ahead and taken the first one during the calendar year, not using the grace period, and then taking your second distribution in the second year, obviously. The reason you do not want to mess up with these required minimum distributions is because there is a 50% penalty if you fail to take it. So let's say that you were supposed to take $20,000 out. You only took 10 and you kind of forgot that you were supposed to take more before the end of the year. Comes time that you're filing your taxes, and suddenly on your tax returns, it becomes clear, oh my gosh, I failed to take that extra $10,000. So first of all, you need to go take out the $10,000. Second of all, you're going to pay a $5,000 penalty on your tax return for having failed to do that. Now, there are waivers for reasonable cause, but we'd rather just get it right to start with. So back to those early distribution penalties. I told you we would get to those in a minute. So if you're under 59 and a half, like I said, generally you're going to owe a 10% penalty in addition to any income tax that you owe. The exceptions are, though, if the account owner is deceased, or if the account owner is disabled. Both of those allow early distributions without penalties. Also, if there was a divorce and there was a qualified domestic relief order that the account had to be split, that's an exception. There's a rule that's by people in the industry referred to as 72T. It refers to the section of the IRS code that allows this. It allows you to take a series of substantially equal payments over a period of years. It's always at least 5 years or until you reach age 59 and a half, if that's longer. There are strict rules about what substantially equal means, but that is a workaround for folks who might need to take money out starting, let's say, at age 52 or 55 or what have you, and not qualify for any other exception. With employer plans, if you didn't leave work until you were at least age 55, and then subsequently we're taking money out of your employer plan before you reached age 59 and a half, that's an exception. You have a little 4-year window there that you could take money out without penalty. And IRAs have a couple of unique exceptions to early distribution penalty, one for qualified higher education expenses and the second for first-time homebuyer expenses. And I mentioned earlier about my website, where you'll find a list of resources that will help you with some of these things. If you need more information about these early distribution penalties and exceptions, there are some things on my resource list that you'll be able to link and go read from reliable sources that will elaborate on that. The Secure Act that was passed at the end of last year also created a new early distribution exception, and it is for parents. It allows you to take up to $5,000 for childbirth or adoption, and it's per qualifying event. So if you you gave birth to a child in 2021 and you adopted another child in 2021, you'd have two separate events, and each parent could take up to $10,000 from their retirement plans without penalty. There would be tax though. However, this early distribution penalty is unique. That's why I put it on a separate slide, because it allows repayment. It allows you to treat this as if it were just a loan, if you will. It can be repaid, and that is unique as far as avoiding early distribution penalties. So what about these RMDs? The good news is that when you must take RMDs, your financial institutions will send you a notice, probably in the first quarter of the year, telling you how much you have to take out. But if you're like me, I like to know what's coming up. So here's how you calculate an RMD. First of all, you look at the statement for your account from December 31st of the prior year. Then you go to IRS publication 590-B and you look in the appendix at this thing called the Uniform Lifetime Table. What you see is a list of ages starting from age 70 and going forward. I'm guessing that they're going to update that so it only starts with 71 because now we're taking distributions slightly later than we did before. But for each age, for example, if you look at age 72, you'll see that there's a distribution period number beside it, which is 25.6. This is telling you to take 25.6 and divide it into the balance in your account from December 31st of last year. The result is your required minimum distribution. Then all you have to do is make sure you take that amount no later than December 31st. And a word to the wise, do not wait until Christmas Eve to start trying to get this processed. You are at the mercy of the individual who is handling these things. And if they're overworked and can't get it done, you're the one who'll pay the penalty. So, start it weeks, if not months, before the end of the year. Now, about what was that 2020 what? That 25.6 number, that distribution period for somebody who is 72 years of age, what is that? And sometimes people will say, well, maybe it's life expectancy. And that's a really good guess. It's not an individual's life expectancy, but what it is it's based on the life expectancy of you and a spouse who is 10 years younger. The IRS doesn't care how old your spouse really is, or even if you have a spouse. They will give you a hypothetical spouse who is 10 years younger, and it's your joint life expectancy that is used in this uniform lifetime table to calculate your distributions. This is actually a benefit to most of us because by being assumed to have a 10-year younger spouse, it gives us a longer joint life expectancy, making our required distributions smaller than it would be otherwise. Now, if you're in a situation where you actually have a spouse who is more than 10 years younger than you, then you can use that actual age of your younger spouse by going to a second table known as the Joint and Last Survivor table, and it will calculate a joint life expectancy for you, and you will use that number in calculating your required minimum distribution. Only account owners get to use joint life expectancy. Beneficiaries are limited to using the single life expectancy table based on their own age only. You have to take RMDs for each account. So RMDs are per account with two exceptions. If you have multiple IRA accounts, the IRS doesn't care which IRA or IRAs you take the distribution from, as long as you take the correct total amount. So you can add up the balances in all of your IRAs, calculate a single RMD amount. You can take it all from one IRA. You can do it pro rata across all of your IRAs. The IRS doesn't care as long as you take out at least the required minimum distribution that you've calculated. If you have multiple 403B accounts, this happens a lot less often, but there's going to be somebody out there that does have more than one 403B. You can do the same thing. You can total up the balances in your 403Bs, calculate one RMD, and again, it's up to you. Take it all from one 403, that's fine. Take it a piece from all, that's fine, ever how you want to do it. And there actually is one exception where you don't have to take an RMD, and that is that you're still working, and then you are not required to take an RMD from that employer plan. Not all plans, just the plan of your current employer. And this also applies to business owners if you have an employer, if you have your own retirement plan for your business. There is one way to take these required minimum distributions and avoid paying tax on it. RMDs are taxable income unless they're coming from Roth accounts. So many people are surprised at how well they've done saving for retirement. They're surprised at the size of their required minimum distributions. And then the final surprise is the amount of income tax that they owe. So this is one way to avoid income tax on these RMDs. And it's something called the qualified charitable distributions. Here are the rules. Only applies to IRAs, no other kind of retirement account, IRAs only, and not to any employer type IRAs. It's only traditional individual IRAs. You must be at least age 70 and a half. That's not a typo. They did not change this requirement to age 72 to line up with the required beginning date for RMDs. They left this at age 70 and a half, which has led to some confusion. But you must have reached age 70 and a half by the date of the distribution. Can't just be sometime during the same year you turn 70 and a half. Like if your birthday is June 14th, you cannot do the qualified charitable distribution on May 14th. It's got to be June 14th or after, since June 14th is your birthday. But surprisingly, if you have inherited an IRA, you can still do qualified charitable distributions. Here's how it works. The distribution has to go directly to the charity. Now, typically you do that by filling out a form with the custodian of your IRA, telling them how much you want to send and to what charitable organization, and they send it. The alternative would be that they cut the check to the charitable organization, but perhaps send it to you so you have the privilege of delivering it. At any rate, you never had control of the money, all right? It never went into any other account of yours. The money is going directly to the charity. The limit is quite lenient. It's $100,000 per person per year. And there are a lot of reasons to like this. Through 2025, individuals who intend to make charitable contributions are probably going to find that they save more in their taxes by doing the QCD, the qualified charitable distribution, than by making regular charitable contributions just by writing a check or, donating whatever. You're going to find that you get more bang for your buck with the qualified charitable distribution than making other sort of regular charitable contributions that you're accustomed to itemizing when you file your taxes. This is going to remain largely true through 2025. We're going to have some tax law changes in 2026, where the rules about standard deduction and itemized deductions are going to switch back to the old rules. Most people will still find QCDs more beneficial, but there will be a few more exceptions at that time. And let me just mention something I learned a month or so ago on a really good training webinar that I attended. The time when time when a qualified charitable distribution, this QCD, will not work best for you, and something else would be better, is possibly a situation where you have appreciated property that is currently worth a lot more than you originally paid for it. And that's what you want to donate to the charity. That may come out better for you than doing this QCD from your IRA. But for most people, here's what we're looking at. You see this red line? This red line represents $2,480, which is the amount of the standard deduction for a married couple filing jointly. Now, for a single person, it's half this. For head of household, it's a little bit less than this. But I've chosen married filing jointly for my example here, where any couple who files jointly automatically is entitled to a standard deduction under today's rules, $24,800 for 2021. If you then do your qualified charitable distribution from your IRA and you have the money go directly to the charity. And let's say that you're looking at donating $10,000. Well, that's great. On top of your standard deduction, you're also going to reduce your taxable income by the full $10,000 of this QCD, because that $10,000 that would have been a taxable required minimum distribution just disappears. It's no longer taxable income because it's a QCD. Now let's look at an individual who said, I don't really buy it. I'd rather just write my check. I really like, doing things the way I've done them all along, and it's itemizable, right? I've always itemized my deductions. So what's not to like? Well, here's what's not to like. You're only going to get a benefit from your charitable contribution to the extent that it raises you above the red dotted line. So let's look at the itemizable deductions that somebody might have and what it takes to get to the red line and then get above it with that charitable contribution. As has been true in the past, you are able to itemize and deduct state income tax and state property taxes, or I'm sorry, local property taxes, but it's now limited to $10,000, regardless of how much tax you actually paid. So in my example, I'm saying the couple paid $12,000 in these state and local taxes, but they can only deduct $10,000. All right, so we have $10,000 of itemizable deductions. They have a mortgage that was used to buy or improve the home. That's the requirement now to be able to deduct mortgage interest. So yeah, their $7,000 of mortgage interest is still deductible. That gives them $17,000. They need another $7,800 before they hit the dotted line. So $7,800 of their charitable contribution that they're itemizing doesn't get them any extra benefit. It just gets them up to the line. And so the only amount of their charitable contribution that they actually benefit from on their income taxes is $2,200. And the benefit will be whatever their tax rate is times that amount. So for most people, clearly, they save more in their taxes by doing the QCD. If they are, say it with me, age 70 and a half, and the money is coming from a regular IRA, not an employer IRA. And here a little bit more information about advantages of the QCD above and beyond what we just talked about. What I just showed you is how much it's going to save you just in reducing your taxable income. But qualified charitable distributions don't just reduce your taxable income, they also reduce your adjusted gross income. Thinking about your tax return, you know how you add up all your income, and then you have a few deductions that you can take before arriving at your adjusted gross income. After you calculate your adjusted gross income, then you take your standard deduction or your itemized deductions, and that gives you your taxable income. Itemized deductions reduce taxable income, but they don't change your your adjusted gross income, which is higher up on your tax form, but a QCD does. A QCD has actually removed taxable income, reducing your adjusted gross, and therefore it may help save you tax on Social Security benefits, because how much of your Social Security benefits are taxable depends on the total amount of your income. It could also save you from some of the more punitive premium increases on Medicare, because that's also based on adjusted gross income. If you have substantial income to the tune of $200,000 a year for individuals, $250,000 a year for married filing jointly, you may be subject to the net investment tax. And because the qualified charitable distribution reduces adjusted gross income, it may also reduce or avoid net investment tax for you. In addition, there could be other tax breaks or local things like, property tax for seniors and so forth, where reducing your adjusted gross income may help you qualify for other benefits as well. Itemized deduction doesn't do any of that. One place where you might get tripped up just a little bit with the QCD, most people will not have to worry about this, but some people in Congress thought somebody was going to abuse the system, like that ever happens, and they put in a special rule. It's not just about the QCD. The reason they're concerned is that as of last year, there is no longer an age limit for making contributions to a traditional IRA, a tax-deferred IRA. It used to be that once you reached age 70 and a half, that was then the age at which you had to start taking RMDs. The old rule was that once you reached that age, you could no longer make a contribution to a traditional IRA. But that rule went away. As long as you have earned income, that means either from a job or from self-employment, as long as you have earned income, regardless of your age, you can contribute to an IRA. Now, here's where somebody in Congress got a bee in their bonnet that people were going to abuse the system. They're concerned that you're going to, at the age of 73, work, first of all. Second, use some of that employment income to put into a traditional IRA, and, oh my gosh, turn around and yank that money right back out as a qualified charitable distribution and avoid tax on it. So they decided that if you make a deductible contribution, and I'm on the second bullet here, if you make a deductible contribution to an IRA in the year you reach 70 and a half or later, your qualified charitable distribution will be disallowed until you have offset all of those deductible contributions. So let's say you put in $6,000 to your IRA at the age of 73 and another $6,000 at the age of 74. You're going to have to actually take out those $12,000 and pay tax on it before you're going to be able to take a qualified charitable distribution. If you're in this situation, I suggest that you talk to a tax person if it's worth it to you to try to figure out a workaround on this. To be honest, the simpler thing is you don't make the contributions to deductible IRA after age 70 and a half if you're planning to make qualified charitable distributions. There's really not that much tax at stake. I don't know why they felt they had to put this anti-abuse provision in here. All right, changing gears slightly. We're going to talk about rules now that specifically apply to Roth accounts because the rules for distributions are different. Mainly because the contributions that you put into a Roth account, you have already paid tax on. So there will never be tax on your contributions when you pull them out. The only question is whether there will be tax on the growth that's accumulated. So growth is tax and penalty free if you meet a two-part requirement. First requirement is that the account has to have been open at least 5 years. And you must either be 59 and a half or older, dead or disabled. So as long as you meet the 5-year rule and the second half of this by either being, age qualified or dead or disabled, all the growth is not only tax-free, but also penalty-free. When you take money out, the distributions are usually going to be considered to be a pro rata mixture of the contributions and the growth. Let's say that you had contributed a total of, I'm going to pick easy numbers here. You contributed a total of $100,000 over the years. And now there's $50,000 more in the account that's growth. That means when you take it out, 2/3 of each distribution would be considered to be contributions, and the other third would be considered to be growth. So that you would always have some growth in the distribution where you need to meet this 5-year rule, okay? There is an exception, though, to how the distributions are viewed, and the exception is the Roth IRA. With a Roth IRA, the rules say that your distributions will come first totally from your contributions. And only once you've taken out all of your contributions will you be considered to be taking growth out of the account. Now, for a lot of us, this isn't any big deal, but I'll tell you who it is a big deal for. I think it's our younger workers, like in their 20s in particular, for whom retirement is 40 years away. Putting money into a retirement account can be a little bit daunting. What if they need the money? They can't see 40 years into the future. If they put their money into a Roth IRA, it means that if they fell on hard times, they used up the emergency fund that they have on hand, they could take money out of their Roth IRA without tax and without penalty until they have withdrawn all of their original contributions. I think it's a little bit reassuring to our young adults who just don't know if they're going to be able to leave this money in there until they reach retirement age. And the other reason that a Roth or why any Roth version of a retirement account might be a good choice for a younger worker is they're in the early years of their job, right? They're probably making the least income they will make over the life of their professional career. And so they're probably in the lowest tax bracket they'll be in for a long time, or they may be. And therefore, a deductible contribution doesn't really help them that much. A Roth can often be a good alternative in that situation. Another special rule for Roths, okay, so we already talked about this one, that distributions come first from contributions. But the other big special rule for Roth IRAs is about required minimum distributions. There is no required minimum distribution for the account owner. Doesn't matter whether you're 72, 78, 82, no required minimum distribution for the owner. However, there are required minimum distributions for beneficiaries. Now, this next slide is sort of an outlier. It had to go somewhere, and this is where I put it. What if you took your retirement account and in the retirement account, you annuitized, meaning that you exchanged the lump sum or a portion of it for a guaranteed monthly income for the rest of your life, an annuity. If you take an annuity like that, it will fulfill your requirements for RMDs. You don't have to worry about it. And that includes if you took something that's a little bit different called a deferred guaranteed annuity, a deferred guaranteed monthly benefit that would be starting at some later date, assuming you survive until then. It could be 75 at which it starts, or 80 or 85. Even though you're receiving no money currently, that deferred guaranteed monthly benefit nonetheless qualifies and meets the requirements of the RMDs. Now, moving to the last big piece tonight, talking about beneficiaries and the rules that apply to them. First, you as the account owner, your job is to choose and name beneficiaries. You can name both primary and secondary beneficiaries. One of the benefits of doing this is that it means that this asset will not need to go through probate. Your beneficiary will be able to show a copy of the death certificate to the account custodian, ID that proves who they are, and they take possession of the account. It's that simple. Or it's pretty simple. It does not go through probate. If you named your beneficiaries before the Secure Act was written, you may want to review who you named, because we used to tend toward naming younger beneficiaries because it was going to let them stretch distributions out over their life expectancy. That generally doesn't work anymore. Also, it was fairly common to use particular types of trusts as beneficiaries, and many of the advantages of those trusts was taken away or done away with as a part of the Secure Act. So when did the Secure Act go into effect with these rules for beneficiaries? Generally, for deaths that occurred on or after January 1st of last year. The exceptions are government plans, plans that relate to a collective bargaining agreement, and annuitized annuities, and this is a quote because I don't want to get it wrong, annuitized annuities and annuities in which a future lifetime income option has already been irrevocably selected. Okay, bottom line is that for most of us, the new rules went into effect for any account owner who died January 1st of last year or later. What changed? We used to have a big green box and a big brown box as far as types of beneficiaries. We had people that we were able to designate, we were able to name as beneficiaries, and they were generally able to take distributions from our retirement accounts based on their life expectancy. And then we had the non-people that could not be considered designated beneficiaries because they're entities. They didn't have a life expectancy. And this includes charities, certain trusts, and your estate. And this would include if you failed to name any beneficiary on your retirement plans, and therefore the estate was the default, okay? In that case, you didn't have a designated beneficiary, you didn't have anything with a life expectancy, and the account would have to be emptied within 5 years under the general rule. So we used to have life expectancy distributions, 5-year distributions, just to oversimplify. But now we've got this light green box carved out in the middle here. And under today's rules, only the light green box people get to use their life expectancy to determine their required minimum distributions as beneficiaries. And these guys are officially known as eligible designated beneficiaries. Who are they? It's a very limited group of people. The surviving spouse, I should make that singular. We don't allow bigamy in this country. The surviving spouse of the account owner, somebody who is fully and permanently disabled under the same rules as used by Social Security, somebody who is chronically ill, and I do not have quite as good of a handle on how that is defined, someone who is less than 10 years younger than the deceased minor child, and certain trusts, the same trusts that we would have used in the past for being beneficiaries. Only these can use life expectancy. Everybody else is going to fall under a 10-year rule. So this would include you named as your beneficiary your brother who is 11 years younger than you. Oops, he's not in the light green box, he's in the dark green box. What if you named your child who is no longer a minor child, they're already 25? Well, they're not in the light green box. They're not an eligible designated beneficiary. They're just a plain old designated beneficiary. They're under the basic 10-year rule. So you've seen it in chart form. Here's another way of looking at this. Eligible designated beneficiaries, that short list that I just gave you, they can still take what we used to call the stretch distribution, meaning stretching distributions out based on the beneficiary's life expectancy. They must take an RMD each year. And so they work pretty much the same as the way we used to take distributions from retirement accounts if we name specific individuals. But even on this list of people who are eligible designated beneficiaries, I pointed out that a minor child of the deceased is an eligible designated beneficiary, but there's a catch. That's only true until they reach the age of majority. And after they reach the age of majority, which is 18 in most states, they then become just a designated beneficiary, and they fall under the 10-year rule. So let's say that the deceased had named their 12-year-old child as the beneficiary on their retirement account. So from ages 12 to 18, the child is viewed as an eligible designated beneficiary, must take distributions based on their life expectancy. So that was 6 years that they did that. When they reach 18, though, they move to the regular designated beneficiary list, and they have to take distributions. They have to empty the account within 10 years. Just like if it was your brother who's 12 years younger than you, or your next door neighbor who's 20 years younger than you. Any of those are designated. They're people that you named, but they're just designated beneficiaries. They all fall under the 10-year rule, which means empty the account by the end of 10 years. But there are no required minimum distributions in years 1 through 9. It's kind of an oddity of the current rules, I suppose. We'll talk about some of the ramifications of that in a minute. And then these non-designated beneficiaries, remember the entities, charities, your estate, and certain trusts, rules for them did not change. They've usually always had, they've had the default rule has always been the 5-year rule. No RMDs in years 1 through 4, but they had to empty the account after 5 years. The exception was that if the account owner died after that required beginning date, remember April 1st of the year following the year that they turned 72, in that case, the account balance could be distributed over the deceased's remaining life expectancy. Yes, under IRS rules, even though you're dead, you still have a theoretical life expectancy. Now, one unique situation where an individual has a choice to make and needs to make a thoughtful choice is when it is a spouse who is inheriting the account as a sole beneficiary. 2 routes they can take. The first is that the surviving spouse takes the account as their own. In other words, they become the new owner. And since they are the new owner, they can do everything the original owner was able to do. They can name their own beneficiary, and the rules about whether there are penalties and whether there are RMDs are based on the surviving spouse, because that is the new owner. So if the surviving spouse has not yet reached age 59 and a half and decides to take money out, there will be a 10% penalty. And they will be required to start RMDs when they reach age 72. Their alternative is to treat themselves not as an owner, but as that eligible designated beneficiary. So as an eligible designated beneficiary, that's the category that gets to take required minimum distributions over their life expectancy. However, because it's a spouse, there will not be any until the deceased would have reached age 72. And by taking as a beneficiary and not as an owner, there will be no early distribution penalty, even if the surviving spouse has not yet reached 59 and a half when they take money out. So what is the impact of the new rules under the Secure Act? If your goal in choosing the beneficiaries for your accounts was to allow them to stretch out the distribution over the longest period of time, here's what may have changed. Spouse beneficiaries are now more advantageous than they were before, because if that spouse uses their own life expectancy, they take as a beneficiary, then they can stretch the distributions out over their lifetime, and whoever the successor beneficiary is will have another 10 years. And so today, by choosing a spouse as your beneficiary, it may actually give you the greatest number of years over which to spread the distributions from the account. Conversely, naming very young beneficiaries is less advantageous than it used to be, because unless it's the minor child of the deceased, let's say it's your niece or nephew, they fall under the 10-year rule. The fact that they're 5 years old has nothing to do with it, or the fact that they're 35 years old. As I said, the exception is minor children, but remember, they basically get from whatever their age is now up to age 18 and 10 more years. That's it. So that could be a number of years, but probably not as much as using the spouse beneficiary route. And naming a trust has become less advantageous. Trusts were typically used as beneficiaries for retirement accounts in order to get this long stretch payout. Now, if you haven't used trusts as beneficiaries and you're not planning to use a trust as a beneficiary, you can start writing your questions in the chat, because the next couple of slides are strictly about that. See-through trusts is the specific type of trust that has been used as beneficiaries. typically by owners of larger IRAs where for tax reasons it was important to have distributions stretched over a longer period of time. And this gave them a fair amount of control over those post-death distributions. But under the new rules, those advantages have largely been lost. There is a specific definition of what a see-through trust is. I'll let you read that for those of you that this is critical for. But the problems with the see-through trusts that have happened now is we have two types of see-through trusts. We have conduit trusts and we have discretionary trusts. With conduit trusts, they are generally required once the RMD comes into the trust, it has to be distributed straight on out to the beneficiaries. And the intent was, like I said, spreading this over a large number of years, reducing annual tax impacts. But with current rules, there are no RMDs in years 1 through 9 for almost all situations, meaning the total account will be distributed in year 10. The terms of the trust won't allow them to take things that aren't RMDs out. So the whole thing comes out in year 10, one big tax bomb all at once. What about the other type of trust, discretionary trust? They had the ability to retain the RMDs in the account, but because of the taxation rules for trusts, you end up with a separate but different type of problem here where your trust is going to be paying, compared to an individual, exorbitant tax rates. Trusts start paying the highest income tax rate when they have just $12,950 of income. An individual doesn't hit that, I'm sorry, a married couple filing jointly doesn't hit that tax bracket until they're over $600,000 of income. So I've got a little diagram here for those of you that are concerned about this to help you see there's one situation where you could have a see-through trust that actually qualifies as this brown box down in the lower left-hand corner. That actually qualifies as an eligible designated beneficiary, and therefore we get to use the stretch lifetime distribution of that beneficiary. But if you work your way back through here, you'll discover that there's only one situation where you can end up in this box. All the other trusts are either treated as designated beneficiaries and fall under the 10-year rule, or they're non-designated beneficiaries and are under the 5-year rule, which is probably not what you were trying to accomplish. So, thinking about these rules for beneficiaries, first of all, please make note, are there some actions that you're thinking you need to take? Maybe it is simply looking at who you've named as beneficiaries or naming beneficiaries if you haven't already. Maybe it is visiting with the attorney who drafted that trust that is now the beneficiary of your retirement accounts and seeing if that's still the advisable way to go. Others of you might be wanting to think about making those qualified charitable distributions from your IRAs for your planned charitable giving for this year. If you are age 72, if you have money in a deductible, meaning tax deferred traditional IRA. So before all of this stuff sort of starts to fade from mind, think about and maybe scan back through, if you printed out the handout or have it on your computer, what are the things that you want to think about, talk about, or do? Who do you need to talk about? Do you need an appointment with somebody to work on these things? And as I mentioned, there are a number of resources that might be useful to you to remind yourself and to dig further into what we talked about tonight. Those are all posted on the website. And I've given you one particular link here to a blog by Michael Kitces talking about the issues with the stretch IRA basically having been done away with. He's sort of the financial planner. He does a lot of real in-depth stuff. And even though what he writes is intended for financial planners, I think if this is a topic that you're concerned about, this is like the best place I can point you to for a lot of detailed and thoughtful information. All right, so we're pushing up close at our hour-and-a-half mark here, but I'm hoping that some of you may have taken advantage of the opportunity to post some questions. And I'm going to ask either Jamie or Sam, who's ever monitoring the chat, to come back and tell us, do we have questions?
Yeah, we do have some questions actually. Elaine is wondering, is the qualified education only for you, or can you pay off the kids' college debt with that?
You can pay college expenses of children. I would have to check to see whether paying off college debt is also a qualified expense. It's been too long since I've read the details on that, and so I'm not going to give you an answer I'm not certain of. So Elaine, if you'd like me to look that up for you, go on my webpage, if you would, KarenChanFinancialEd.com. One of the tabs is Contact Karen. And if you'll post that question there and give me your email address, I'll look it up and get back to you about paying off debt.
Okay, and Karen wanted to say thank you, thank you, thank you. This is the single most informative Zoom I've seen this year, so excellent. A
You just made
couple,
my day. Thank you.
yeah, it's awesome. Yes, so a couple of questions that were answered during the presentation, they said.
Okay.
Um, Let's go. So, how likely is it that the next political party that rewrites the tax laws changes the things you just told us, especially the beneficiary rules and RMD rules?
Okay. Um, I am not aware of anything in Biden's proposed tax legislation that was mainly talked about even before the election. I'm not aware of anything that would have significant impact on what we've talked about tonight. The main change that I think you should be prepared for is the fact that the Trump tax changes are set to sunset or expire at the end of 2025. That doesn't change any of the beneficiary rules. What it does change is precise tax brackets and the standard deduction amount and whether or not you can claim exemptions. So your taxes are going to go through changes. If you were helped by the Trump tax changes, then you'll be hurt by the reverse. If you were hurt by the Trump tax changes, then you would be helped by the reverse. Um, the one group that should probably be paying close attention is Biden has been pretty clear that to the extent that taxes go up, that he's really only looking at people earning over $400,000 a year and corporations. And so if those are you, then you should be paying attention. Beyond that, I'm not aware of any plan changes at this point about RMDs. This Secure Act legislation really was the thing that people were kind of thinking might happen, and yet it really kind of snuck in and surprised us with the changes on the RMDs. I'm not aware that there's any discussion about changing them additionally. The one thing that is expected to happen is the life expectancy tables that I talked about, the uniform lifetime table and so forth. There is a plan by the IRS to release new tables revised to reflect the longer life expectancies that we've been seeing building over the last decade or two. But we've seen a drop in life expectancy due to opioids and the pandemic. So personally, I'm not sure whether that will really happen. But if it happens, it's scheduled to be released in 2022.
Okay. And Anne is wondering, if I have a Roth 401k and leave my employer, can I transfer the Roth 401k into my Roth IRA account?
Yes.
Okay. And another question from Anne, if I have a Roth IRA account that is over 5 years old and a Roth 401k account that is only 2 years old, would the Roth 401k account still require 5 years before I can take the money out?
Okay. I'm pretty certain that the rule that applies here is because it's Roth, because you're not doing a conversion. Okay, it's coming from a Roth employer plan to a Roth IRA. I think the fact that your Roth IRA has been open for 5 years, I think that is going to be the only requirement. If you were converting money from a tax deferred account into a Roth IRA, then we have to do some precise calculations about how the money that was brought in reaches uh, meets its 5-year requirement. But coming from the Roth 401k, I don't think that's an issue. And by the way, let's say that your current Roth IRA has only been open for 3 years, but that money was in another Roth IRA before that. You actually look for whether your Roth IRA has been open for 5 years. You look to the year that you opened your very first Roth IRA. January 1st of that year is your starting date. So even if that previous account's not even open anymore, it doesn't matter. As long as you've had any Roth IRA open for at least 5 years, on the Roth IRA 5-year rule, you're good to go.
Okay, so I don't see any other questions. If you have a question, you could pop it into the chat really quick. Steve wanted to say no question here, Karen, but thank you. And thanks to DPL for an excellent program. Yes, this was extremely informative. Thank you, Karen. Um, and yes, so this program is being recorded. As I said at the beginning, if you missed that, we should have that out to you probably by Monday. I will email everyone who was registered today that it will be on our YouTube channel, just like other programs that have been recorded. Some of them are only up for a week or two, but some of them are up for longer. So check out our YouTube channel for those. Elaine is wondering, can we get a copy of the slides? Um, will those be available to participants?
That was the handout that I sent to Jamie. That it sounds like Jamie, you've already emailed out to
Hmm.
folks. So I guess they should check their email, check their spam box, and if they don't see it, reach out to the library, I presume.
Yep, that would be great. If you don't see it in your email, it should have been attached to the email I sent out today with the program link. So if you were able to get into the program, you should have that as well. So, all right. Well, I don't see any other questions. Karen, we're going to have you back. There's just so much to learn from you. So,
Financial life has gotten complicated over the
mhm.
last decades, and there is a lot to do. And it's my pleasure. I'm always honored to be invited back to libraries that I've worked with. So thanks, Jamie, for the opportunity.
Well, thank you. And I hope everyone has a good night.